Welcome back. In the next 9 minutes, I'm going to walk you through one of the most consequential market mispricings happening right now, and it directly impacts your cloud infrastructure holdings, whether you realize it or not. Let's start with the headline. One major AI startup is burning through $15 billion annually in compute costs. That's not revenue. That's not R&D spend broadly. That's specifically the cost to run their servers, GPU, and data centers. And here's what Wall Street isn't telling you. No AI company has yet demonstrated a path to profitability that justifies these expenses. Part 1. The $15 billion compute burn and what IT really means. First, let's establish the math. When we talk about $15 billion in annual compute spend, we're discussing a company paying cloud providers like AWS, Google Cloud, and Microsoft Azure for access to thousands of GPUs, primarily NVIDIA H100s and newer architectures, running 24/7. To contextualize this, a single H100 GPU costs roughly $30, $40, to purchase outright. On cloud platforms, renting one H100 costs approximately $2, $3 per hour. If we work backwards from $15 billion annually, that suggests this startup is consuming roughly 5-6 million GPU hours per year. That's equivalent to running approximately 600-700 H100 continuously, every single day, for 12 months straight. Now here's the critical question institutional investors are asking. What revenue are these compute hours generating? Let's look at concrete numbers. According to publicly available data, major AI startups are seeing the following unit economics. Case study 1. Inference cost structure for a large language model API. The cost to run inference on a single query averages $0.001 to $0.001 in GPU time, depending on input/output token length. Yet the average revenue per inference call is roughly $0.0005 to $0.005. In other words, many AI services are operating at a negative unit economics on the computation side alone, before accounting for data center overhead, networking, salaries, and infrastructure redundancy. A major research firm's analysis in Q2 2024 found that one leading AI startup's gross margin on their API product was actually negative when you properly allocate compute costs, meaning they lose money on every single API call. Case study 2. Training cost spiral. Training new frontier models requires even more compute. The latest generation of large language models require 10-50 exaflops of compute to train. That's quintillions of floating point operations. At current cloud pricing, training a single frontier model costs $50-200 million in raw GPU rental alone. Think about this. To justify that training cost, a company needs to either 1. Monetize the resulting model extensively enough to recoup the cost within 3-5 years, or 2. Continuously release new trained models that each generate proportional revenue increases. Neither scenario has materialized at scale yet. Part 2. The 3 SEC filing red flags. Now, here's where institutional investors are reading between the lines, and where most retail traders are completely missing the signal. When you analyze 10Q and 10K filings from cloud infrastructure companies, 3 specific anomalies are starting to appear. These are the canaries in the coal mine. Red flag #1. Sudden margin compression in the AI segment. Look at AWS's recent earnings. They broke out their AI service margins separately for the first time in Q4 2024. The gross margin on AI-specific infrastructure services, renting GPUs at scale, showed compression of approximately 300-400 basis points compared to traditional cloud services. Why? Because AI startups are negotiating aggressive volume discounts, 50-60% off standard pricing for multi-year commitments. The cost of supporting GPU infrastructure is higher than traditional CPU/memory compute power consumption, and cooling costs for GPU-dense data centers are rising 15-25% year over year. What this means: cloud providers are capturing less profit per dollar of AI compute revenue. If AI compute demand slows, which happens when startups can't justify their burn rates, cloud providers won't have enough margin to offset the revenue decline. Red flag #2. Increased estimated useful life on GPU and specialized hardware. Scroll through the balance sheet footnotes. You'll notice several cloud providers extending the depreciation schedules on their GPU inventory from 3 years to 4-5 years. This is accounting speak for. We're not confident in the replacement cycle for these GPUs. Historically, cloud providers retire and replace GPU hardware on a 3-year cycle because newer chips offer 40-50% performance improvements. Extending useful life to 5-year signals management isn't convinced they'll need to upgrade as aggressively. Translation: demand growth expectations are lower than guidance suggests. Data point: NVIDIA last earnings call revealed that cloud provider GPU inventory levels are at 45-day supply, up from the historical 15-20-day range. That's a subtle but significant warning. Red flag #3. Rising accounts receivable days outstanding, specifically from AI startup customers. This is buried in the footnotes of 10KS, but it's crucial. Days sales outstanding, DSO, for large AI customer contracts has increased from 45-60 days historically to 75-90 days in recent quarters. What does this mean? AI startups are taking longer to pay their cloud bills. This could indicate cash flow stress. They're burning cash faster than anticipated. Confidence deterioration among cloud providers. They're willing to wait longer because they're concerned these customers might not survive to pay margin pressure. cloud providers are extending payment terms as a discount mechanism without explicitly lowering prices. A 30-day extension in DSO might seem minor, but for AWS's AI business, roughly $8-12 billion in annual AI-specific revenue, it ties up an additional $200-300 million in working capital. That capital can't be invested in other infrastructure. Part 3. The historical precedent everyone's ignoring this situation mirrors the 2017-2018 GPU mining craze more closely than most analysts admit. In late 2017, cryptocurrency miners were consuming massive quantities of GPUs, creating a shortage for gaming and professional use. Companies like Nvidia, AMD, and their Fables partners were reporting spectacular growth in GPU sales. Cloud providers were adding GPU capacity at breakneck speed. Wall Street was pricing in perpetual growth. Cloud stocks soared. Nvidia valuation expanded 200% in 18 months. Then in 2018, the dominoes fell. 1. Cryptocurrency mining became unprofitable when coin prices crashed. 2. Miners stopped buying G+. 3. Used GPU markets flooded. Miners dumping equipment. 4. Cloud providers' GPU utilization rates dropped from 65-70% to 35-45%. 5. Cloud providers were forced to write down GPU inventory and idle capacity. 6. Stock prices compressed 40-60% over 12 months. The parallel today. AI startups are consuming GPUs voraciously, but there's no proven sustainable monetization model, just like crypto mining had no fundamental economic basis. When the funding runs out, demand collapses. However, there's one key difference. Crypto mining consolidated to a handful of operations quickly. AI compute is more distributed across dozens of startups. The deflation will be more gradual but potentially more severe. Part 4. Calculating your portfolio impact. Let's make this concrete with a specific example. Suppose you own a $200,000 position in a major cloud infrastructure stock. Let's say it's a company generating 35-40% of its revenue from AI-related compute services. Scenario modeling, based on analyst consensus expectations. Base case, consensus. Cloud AI revenue grows 25% annually, margin stays stable. Your stock compounds at 12-15% annually. Your position grows to $320,000 in 3 years. Bear case, repricing. AI startup compute demand declines 30-40% within 18 months as companies rationalize spending. Cloud providers cut AI-specific prices 20-25% to maintain volume, a classic competitive response. Gross margins on AI services compress. Another 300 basis points. Cloud provider earnings guidance drops 25-35%. Valuation multiple compresses from 25x forward earnings to 18x forward earnings. Under this scenario, your $200,000 position declines to $120,000, $135,000, that's $1.65, $80,000 loss in 12-24 months. Now, what's the probability of this scenario? Institutional money is currently assigning roughly 35-45% probability to some version of this outcome, based on options market pricing and fund allocation data. Part 5. The line in cloud provider earnings that proves the repricing is already underway. By minute 6. I promise to show you the smoking gun in quarterly earnings. The one line institutional investors are reading while retail traders miss it. Find the earnings release for any major cloud provider. Go to the forward guidance section. Look for this specific language. We are moderating our capital expenditure growth expectations due to improved infrastructure utilization efficiency and disciplined capacity planning. Or variations. We're optimizing our capex cycle, or infrastructure investments will be more measured. This phrase, buried in forward guidance, is code for AI compute demand is not meeting our internal expectations, so we're pulling back on GPU purchases. When a cloud provider moderates capex guidance by even 10-15%, it signals deep internal concern about demand sustainability. It typically precedes revenue guidance cuts by 1-2 quarters. Amazon, Microsoft, and Google have all issued these modified statements in recent earnings. The mainstream financial media barely noticed. Institutional investors noticed immediately. Why? Because cutting capex guidance is a leading indicator of demand stress. It happens before the demand actually declines in the financial statements. Institutional investors are positioning their portfolios for the revenue deceleration that will show up in Q2/Q3 2025 earnings. But they are doing it now, while retail traders are still chasing the AI momentum narrative. Conclusion. What you should do you don't need to sell everything, but you should. 1. Audit your cloud infrastructure holdings. Calculate what percentage of each company's revenue comes from AI-related compute services. If it's above 30-35% of revenue, you're carrying significant repricing risk. 2. Monitor the 3 red flags. Watch for margin compression, capex guidance cuts, and rising DSO in the next earnings season. Each one increases the probability of a 25-40% stock decline within 24 months. 3. Rebalance your position. Consider reducing cloud infrastructure exposure by 30-50% and rotating proceeds into infrastructure agnostic software, semiconductor